Hey everyone, and welcome to this explainer. Today, we are tearing into the latest Cummins Q1 2026 earnings. We're going to take those incredibly dense, kind of dry SEC filings and translate them into a clear story about an industrial giant that's currently right in the middle of a massive transition. You know, if you follow the legacy industrial sector at all, you know Cummins is an absolute bellwether. And honestly, their first quarter numbers present this really fascinating puzzle of conflicting signals. So let's figure it out.
Here is our roadmap for today. We'll kick things off with Q1 2026, headlines versus reality. Then, we'll unpack a major one-time charge, look at how Power Systems is surging ahead, break down the segment performance, review capital returns and guidance, and wrap up with the road ahead for Cummins.
All right, Part 1, Q1 2026, headlines versus reality. Let's just dive right into the central mystery of their first quarter performance. Because on the surface, the top and bottom lines are telling two completely different stories.
Right out of the gate, Cummins dropped a massive revenue number on us, $8.4 billion for the first quarter. That is a super solid 3% increase year over year. And this top-line growth, it was driven heavily by strong international demand, especially over in China, which really successfully offset some of the sluggishness we've been seeing in the North American truck markets. Honestly, pulling off a top-line beat for a company of this sheer size is no small feat.
But here's the catch. Despite that 3% revenue bump, net income actually fell off a cliff. It plunged from $824 million in Q1 of 2025 all the way down to $654 million this quarter. Diluted earnings per share, those dropped from $5.96 down to $4.71. So what's the deal here? How exactly does a company make more money on the top line but walk away with significantly less on the bottom line?
Well, to understand why, we've got to look at segment EBITDA. If you strip away the taxes and accounting adjustments, you get a much clearer picture. It's kind of like inspecting individual slices of a pie to see exactly which business units are driving the real profit and which ones are just dragging the whole thing down.
Which brings us to Section 2, unpacking the one-time charge. Let's figure out what actually caused that brutal drop in the headline net income.
Okay, the main culprit was a massive $199 million special charge. Cummins basically took this hit on purpose. It was a strategic decision to sell off their low-pressure fuel cell business and settle up the related customer obligations. This whole thing lived inside their Accelera segment, which is their zero-emissions division. So that $1.44 per share hit to earnings, it wasn't an operational failure. Actually, scratch that. Let's call it what it is, a deliberate structural pruning.
And when you look at how this frames the core health of the business, it's pretty eye-opening. If you include that $199 million charge, their overall EBITDA margin sits at 15.4%. But when we isolate and remove that special one-time item, core operations actually stayed incredibly strong at a 17.7% margin. That is virtually identical to the 17.9% they posted a year ago.
Moving on to Section 3, Power Systems surges ahead. Because if the core business is holding steady, even with a weak North American truck market, someone has to be doing the heavy lifting, right? Let's talk about the absolute standout slice of that profit pie. You guys, this segment didn't just grow, it absolutely crushed it. Power Systems delivered a staggering 29.5% EBITDA margin on $2 billion in sales. That is a 19% jump in sales year over year. To see nearly a 30% margin in heavy industrial manufacturing, that's just phenomenal.
And the catalyst for this wild growth is hiding right in plain sight. As CEO Jennifer Rumsey pointed out on their earnings call, this record performance is being directly fueled by the explosive global demand for data center power generation. I mean, think about it. As the AI revolution demands more and more computing power, data centers are multiplying like crazy. And every single one of them needs the massive, reliable backup generators that Cummins builds.
All right, Section 4, Segment Performance Breakdown. So how did the rest of the company fare against this massive data center boom? Looking across all 5 segments, you can see exactly where the cash is flowing. Distribution is the heavyweight at $3.1 billion in sales, which is up 7%. The traditional engine segment pulled in $2.7 billion, and components brought in $2.5 billion. Then we have our star player Power Systems at $2 billion, and way down at the end, the zero-emissions Accelera segment sitting at $101 million. What the data really reveals here is a perfect balancing act playing out across the company. The traditional legacy sides of the business
engines and components saw sales drop 4% and 5% respectively. Why? Because of a cyclical slump in North American heavy and medium-duty truck demand. But that weakness was beautifully balanced out and honestly overcome by the massive data center surge boosting the power systems and distribution segments.
Meanwhile, the Accelera segment absorbed a $277 million EBITDA loss. And remember, $199 million of that was just that one-time fuel cell charge. Management was very clear that this move reflects lower expectations for hydrogen adoption in the near term. They are intentionally tapping the brakes here, focusing their investments to cut future losses in unpromising tech, and pivoting toward much more viable zero-emission paths for their long-term strategy.
Okay, Section 5, Capital Returns and Guidance. The real question is, how does management view all of this internally? Well, despite the mixed segment results and that one-time hit, they are highly confident about the near future.
In fact, Cummins proved its operational health by handing a hefty $519 million right back to shareholders this quarter. They did this through a mix of dividends, paying out $276 million and share repurchases of $243 million. They also doubled down on a really strong long-term goal to return 50% of operating cash flow back to shareholders over time.
And here is the absolute kicker. This underlying strength gave them the confidence to significantly raise their full-year guidance. Previously, they were expecting revenue growth of 3 to 8%. Now, they're projecting 8 to 11%. On top of that, they bumped their expected EBITDA margin range up to between 17.75% and 18.50%. They're seeing North American on-highway markets finally starting to thaw out, while that data center demand just continues to absolutely crush expectations.
Finally, Section 6, the road ahead for Cummins. Let's zoom out. What should you actually take away from this explainer regarding this legacy industrial giant?
The core narrative here is resilience. Cummins is successfully weathering a nasty cyclical low in the trucking market. They are making the disciplined, tough choices to shed unprofitable zero-emission tech in their Accelera segment. But most importantly, they are smartly and aggressively leaning into the massive tailwind of AI and data centers to drive record profitability. So I'll leave you with this final thought to chew on. As the AI boom accelerates and this massive data center build-out continues, is this new growth engine going to be enough to fundamentally shift Cummins from just a cyclical trucking stock into a literal AI-adjacent powerhouse? It is a fascinating transition to witness, and you can bet we'll be watching closely as they execute this playbook through the rest of 2026. Thanks so much for joining me on this explainer, and as always, keep learning.